Well, good morning, John. It's good to see you again. We're recording this on Thursday morning. We've just seen NVIDIA's quarterly result, which came in more or less as expected, and the market, I think the S&P 500 ended up at an all-time high. But there has been a bit of a cloud over the US market in recent times, with President Trump ostensibly firing one of the governors of the Reserve Bank in the United States, the Federal Reserve. Her name's Lisa Cook. John, do you think that this is something that's going to trouble the market much, or is it it's all in the price and no one really cares?
Well, let's put it in this context. I think we've been speculating about a move on the Federal Reserve for many months, Paul.
Yeah.
We started alone. I think now it's becoming more widespread, the view, because it's becoming obvious that's what's going to happen. A lot of rumours regarding Jerome Powell and whether he'll stand down under stress, I guess. But this is the game plan. And one of the reasons why I think the market's being so strong, there is an argument regarding earnings, I admit, particularly from the larger companies. But I also think it's being flagged to the capital markets that the Trump administration is going to try and wrest control of the Federal Reserve and dictate monetary policy, dictate lower interest rates, probably lower rates than they would normally be under an independent central bank, measured against inflation, and most likely the introduction of QE, and particularly if the tariffs don't start generating significant revenue and help balance the budget. So the two things to balance the budget or bring the budget back into a lower deficit, significant income from tariffs. We're not seeing real evidence of that as yet, and driving down the interest costs of the American government through manipulating bond yields. Now, lower bond yields, basic market theory, drive down bond yields, drive down the risk-free rate of return, and therefore push down the earnings yield of the stock market, push up the PE, and you get the performance. So I suspect there's a lot of front running going on in anticipation of the playbook, which is, should we be concerned? Obviously, if the market gets pumped up in anticipation of something occurring, the risk is that when it occurs, there's a correction. There's a significant risk that it doesn't occur. There'll be a correction as well. So you're looking at a situation where elevated prices do put a lot of risk into the American stock market.
Yeah, I mean, from a valuation point of view, the US is at record highs, as we know, but it's also on very stretched multiples, around 23 or 24 times future earnings. Just think through the implications of what you've just said. If there's pressure on the Federal Reserve to reduce rates, and less independence for the Fed means that the inflation cat gets out of the bags later rather than sooner. Probably a good trade to go long kind of 2-year treasuries and short 30-year treasuries as a kind of strategy. Does that make sense to you?
Well, it would make sense if we didn't have QE. And we've seen bond managers taking that tact in previous QE cycles, and there's been some historical disasters by some of the major bond managers in America who didn't understand that QE infects the bond market. So the bond market doesn't trade where it should be based on free market. It trades on where it's directed through printing of money. So I take your point, but I would be doubtful. And the 10-year bond market's been steadily rallying, and you can only say that's on the basis that there's an expectation that QE is going to push down the whole yield curve of the American bond market. So we will probably still see a upward sloping bond market unless we get a recession, but it just sets at 1% to 2% lower than where it is. So cash rates go from 4.5 to towards 2 if we get a Trump Federal Reserve, and 10-year bond goes from 4.25, say, to 3. Still up, is still an upward slope, but every part of the bond market has been compressed and generates a short-term return for the bondholders. But once that plays out, what's next? And you just got to hold course as investors, but be aware of the heightened risk, which you're alerting everyone to with the PEs we're seeing.
So the key narrative driving the US market has been the AI boom, I guess, and NVIDIA proves that there's still some way to go, but the increases in its earnings seem to be decelerating from virtually doubling to up 75%, now up 56%. So the rate of increase is slowing. There's still huge commitment by the megatech companies to spend on further AI infrastructure, chips, so on. Something like $500 billion committed for next year. Is this looking bubbly to you, or do you think that, eventually there will be winners and losers, and presumably the big get bigger and get stronger, and the weak fall by the wayside?
Well, we've talked about this.
We have.
AI it's a revolution, and we don't know where it's going to end up, and everyone can't be winners. But I guess the thought process around AI is it'll be significant productivity enhancement to the world economy, starting in America in particular, and then flowing across China and then to the rest of the world. That productivity improvement can be measured by, improved operating margins for businesses, and particularly, I would say, better services provided by governments who quickly adopt AI in their service areas. And we don't want to go into the issues regarding Australian bureaucracy and the service levels which we're seeing. We've got a bloated Australian bureaucracy, public service, and we don't really see better service levels going to the public, but that's another issue. It's going to be interesting to see how AI plays out and where the benefits of that productivity improvement, how they flow and who they flow to. Now, there's obviously the starting point where the developers and the product suppliers of AI, the batteries and the chips and all that, there's a kickstart there, and then there's the warehousing of the information, and then there's the electricity supply. So they're all tangible winners, but ultimately the usage of AI in my thought process drives down the cost of delivering services. If that's just grabbed as a gross margin improvement, that's great for those adopters. If it becomes a more competitive landscape and AI allows new competitors to come into certain markets without the massive capital investment required, it lowers, it decreases moats and lowers barriers, then you could get a tremendously more competitive landscape and some deflationary effects.
Yeah, that's interesting.
So, you can be very bullish and you can be a little bit sanguine. And I'm sitting here saying, look, I think markets always rally hard on new technology, and then they settle, and then they reflect. And we're probably about to enter a reflection stage as we actually see what the benefits are. And then we're going to see what the governments do, and do they restrict it? Because there are some hideous effects of AI, which we're seeing, impersonation, stuff like that, fraud, scamming. So we've got to be careful there. So that would require a government response. Last week at the productivity roundtable, we saw the ACTU come in and say we want AI regulated. It wasn't clear what they wanted regulated, but they were arguing that it has to be regulated, whatever it is. So you can see that it's going to be a difficult period as this rolls out. So yes, we want to be exposed as investors, but we want to be sensibly exposed.
Let's switch to the Australian reporting season. We're in the middle of the throes of it. There've been, I think last week we described the reporting season to that date as pretty brutal. There have been some brutal reactions and responses. I was thinking of Woolworths yesterday, which was down, I think, 14% in one day. Another stock, Domino's Pizza, down, was it 22%? Domino's is fascinating because I looked it up, and 4 years ago, virtually to the day, the stock price was $150 a share, and today it's 1/10 of that, $15 a share. And I remember you warning against the love affair with Domino's at the time. So what have we learned from this? Are markets so kind of meme driven that they don't pay any attention to fundamentals?
Well, equities are perpetual securities, but markets and market participants tend to take current growth rates and assume it goes into perpetuity, and there's absolutely evidence suggests that's impossible. And that's where markets and pricing get ahead of itself, and then you get reality setting in. And as you mentioned earlier from the video, you get extraordinary growth rates for small companies early on, and as they mature, and Nvidia is not a small company, but as growth matures, you get very high growth rates coming down to more sustainable. They still would be exciting growth rates compared to the market, but then you overlay the PE, which the market's paying, and very often you can see that the market's paying multiples of revenue, not multiples of earnings or multiples of cash flow. And at the end of the day, it's going to be, what does a company generate? What can it return to shareholders? Which is the ultimate decider of value. And here we've seen Domino's go through the whole cycle of a entrepreneur who ran it quite brilliantly, took it to the world, but he really struggled to replicate what he did in Australia anywhere else. And the mistake the market made said, well, he can replicate what he did in Australia, in Japan and Europe, and he failed. Now, there's a lot of historical evidence, Paul, that Australian companies more likely than not fail when they try and take what they've developed in Australia. And we're seeing some very big companies fail to take their good businesses and their good businesses in Australia into international markets, and they sort of hit a completely different competitive landscape. And it's incumbent on Australian investors to understand that. We're a small market, we're fairly unique. To some extent, a lot of international players don't want to compete here because it's too small. So it's a free kick to some Australian companies as they develop their product and their brand, but they can't replicate it in international markets. It's a big opportunity if they can, but we're not the only players in pizzas, so to speak.
Yeah.
And you would be very naive to think we are, but that's what markets do. They get excited and make some fund managers look tremendous for a while, but when you reflect on it, the stock's down 90% from its peak.
Yeah.
So there were equity managers claiming they were geniuses who owned Domino's, but they actually were lucky. They were lucky that the market revalued that stock to a ridiculous price, and they took the benefit. And now that you look back and say, well, it's interesting when you do that and look at stocks that fund managers buy, were they really momentum investors who were lucky with excessive momentum? And then time eventually brings these things back to reality, and it's an interesting thought process. So, I think the idea is to stick to value investing, be realistic. Yes, you can make extraordinary returns in the stock market, but you can make extraordinary losses if you actually don't know what you're doing. And just leave it at that, Paul, I think.
Yeah, I think so. John, this week we did get some economic data. The CPI number came in quite a lot higher than expectations, and seems to have put the idea of a September rate cut back in the drawer, but still leaving it open for November. Were you surprised that the CPI was so much higher than market expectations? It seems to have been driven by electricity charges.
Well, don't get me started, Paul. Honestly, and it is a quandary that Australia wants to be so uncompetitive in a resource and a utility which we have abundant supply of, and we export to the rest of the world. LNG, gas, uranium. Well, less so coal, I guess, but we are an exporter of energy, and yet we haven't been able to supply energy at a reasonable price to ourselves, which is, undercutting the ability of Australia to build a diversified economy. So that figure, to answer your question, did surprise. Barrenjoey, to their credit, their economists did forecast that the market may be surprised on on the inflation number, so that was well done by them. But it certainly has put a back foot to the Reserve Bank's cutting. You would have to say that November cut is very doubtful now. This inflation has to be managed. I keep on saying it needs. See, the productivity roundtable last week never talked about, well, how do we manage inflation, which would then drive cost management in businesses, encourage businesses to invest, to grow and get productivity improvement. So, and I keep on maintaining there has to be some arrangement between the labour market, the average worker, and the employers and the government. How do we incentivise average workers not to keep on pushing wage increases through to chase the cost of living increases? Well, the way to do that is to manage the cost of living and say to workers, look, we'll give you a tax cut, don't push for a wage rise, and try and cut that part of the cost out of doing business. On the other side, the other big issues are, as we know, energy costs. It's just a big issue for running businesses, and we have to manage it down. And 13% increases over 12 months in the cost of energy is a disgrace. That's 3-4 times greater than the inflation rate. And, the government and the bureaucracy have got to hold their head in shame and say, look, we're stuffed up here. We need to fix this, because that inflation just rolls into ongoing, that cost of energy rolls into ongoing inflation. And it starts another round of price increases and wage increases. So that was the disappointing about that productivity discussion last week, is that they just don't admit the mistakes which have to be fixed. It's almost like they hide it. They don't even acknowledge it, that energy prices are and we've talked about it, Paul. We've done presentations about the cost benefits in the Middle East and throughout Asian countries who are very strongly managing their cost of energy. We don't seem to want to do it here.
No. John, there's only time for one more question, but I did want to ask you about the big commodity players. The material sector is the one sector that's actually performed quite well over the last 3 months. Materials have gone from an underperformer against the broader index to an outperformer. It's up 12% and probably led by BHP, which I think is at its high for 2025 at the moment. Because there's no recession anywhere, and China's increasing, it's improving its economic growth, albeit quite slowly, but commodity prices have held up a lot better than expected, and the big resource stocks haven't really moved that much. They still seem to be on relatively modest multiples. Do you see an opportunity there?
Well, I think they're part of the broader market rally, which obviously is being tested through reporting season. We've had a very strong equity market, if you think about it, leading into April. But it was very centred on a few stocks, particularly in Australia, and we had that CBA rally to $180, and then we've had the tariff, and then we've had this ongoing issue. Markets recovered, interest rates are being cut, and the rally of the equity markets being more broader based. And I'd say to some extent the laggards have caught up. Now that's great. And then you have the reporting season, and the broad rally is then checked when the numbers come out, and all of a sudden the hedge funds and the shorters get involved, and they go and punch holes in parts of the market. And you mentioned CSL, Woolworths, as examples. We're at an elevated level now, and it's open season for hedge funds to start punching holes in stocks. And that might throw up opportunity in some of these, as I said in an earlier question, these are perpetual entities. And big companies will correct. Unless there's something terminally wrong with them, they will adjust their management, adjust their investments, strategy to do better. Okay, so when these big companies, probably not a time to buy them in the last 3 months, but as some of them get hammered unfairly, by hedge funds. And think about what hedge funds do. They have to short stocks, and go long stocks. They run these match books. So they're always shorting and always buying and always using leverage. And so they punch hard. But often when you look back in time, they punch too hard, unless they've got a terminal stock they're targeting, like something which is going to go broke. But often they push down big companies, and they continue to run a short position, and it takes a while. Then the market will buy it back, especially in a market where the market's comfortable as an equity asset class. The really good stocks become overpriced, and then the broader rally comes back, and some of these oversold stocks come back again. So I'm ducking and weaving on your question, but I think the resources have been dragged up by the broader equity rally. They needed to recover because when you see the banking index rally and start trading at 20 times earnings, then why wouldn't resource companies go from 12 to 16 times and something like that? So that's what I think it is. I also think that what Trump's doing and forcing Europe to start investing is good for commodities, and I think China's going to continue to support its economy, and India's coming on board. So there's no reason to expect a worldwide slowdown, and so commodities and energy are beneficiaries when you think about it.
Yeah.
So, but I do think it's a very fully priced market. Sort of now it's probably it's going against the grain for a while, where some of these stocks get oversold. You probably pick them up, and some of the ones which are run hard and really are over the top a bit in terms of historical valuations, is probably can de-weight them. But that's not what hedge funds do. Hedge funds tend to buy the rally and punch holes in it.
Well, we'll have to end it there, John. We've gone over time, but always interesting. And thank you very much, and we'll see you next week.